Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, welcome to the latest edition of the ASB Investment Podcast. As always, I'm your host, Nigel Grant, and today I'm joined once again by my right-hand man. He's actually on my right-hand side. He's actually here. He's rural New Zealand's very own Warren Buffett. He'll love me saying that. He's our own head of asset management at ASB, Mr. John Smith. How are you, my friend?
Yes, I'm good, thanks. Always with the hyperbole. But I'm good, thank you.
I do it as much because I like to make you squirm a little bit. And alongside John, we're joined by two very special guests. And in this instance, I should probably say partners instead of guests, who are here to celebrate a very special milestone. All the way from Sydney, we have BlackRock's investment strategist, Will Porter. Welcome back.
Thank you, Nigel.
And head of BlackRock Australasia, Jason Collins, who we're here to celebrate 3 years of partnership between ASB and BlackRock. How are you, champs?
Fantastic. Thanks, Nigel. Thanks, John.
And it's great to have you both here in person. When we had you on the podcast at the beginning of the partnership back in 21, Sydney was, gosh, it's quite traumatic to reflect on this. Sydney was in lockdown. Jason, you were the only person in BlackRock's office, and David, who wasn't able to make this trip today, was hunkered down on the Central Coast. Like, to say what a ride the last 3 years have been is probably an understatement. A lot has changed in that time, hasn't it?
Yeah, I mean, so much. I don't even know where to start.
And Will, any thoughts in terms of what you've sort of noticed over those 3 years and what's changed or not?
Yeah, look, 3 years, I actually wasn't here at the beginning of the partnership, but I'm 18 months in and look, it's been an incredible joy to work with the team at ASB, and I know that those that were there from the beginning always look pretty fondly along the partnership that we've got here with ASB.
Oh, what? And John, I recall when we discussed this 3 years ago, you made the point that, and you brought it up again, in the past week, that there's nothing outsourcing about this. It was insourcing. Can you describe again how eloquently you do so, and kind of, what that term means and how it's played out in practice?
Yeah, sort of like outsourcing is quite an arm's length, sort of like impersonal type of sense associated with that. The BlackRock partnership we started 3 years ago, I mean, we need to recognise that we actually started the relationship with BlackRock back in 2016. And we developed a really, really strong relationship, really strong cultural alignment with BlackRock. And in 2020, as we were putting this together, we got into 2021 when we established it. But when we put it together, the problem we were trying to solve was how do we expand our capability, and the way to do that is through our discussions with BlackRock was to sort of like add them to our team effectively. I mean, there's a huge capability in BlackRock, and if we can effectively add that to our team and essentially insource that capability, and we work together as a team, then that's the perfect world. And because of the relationship we have with BlackRock, we felt that we could make that work. Now, has it worked? Absolutely. It's just been awesome. We have such a strong relationship. We're talking every week, often every day, and we've achieved some great things. So, yeah, it's worked really well.
And Jason, in your eyes, how's the partnership gone with ASB? I guess, how's it evolved or deepened over that period, and what are you most proud of?
Well, I mean, it started out, as John said, in 2016, and if you go back then, it was a simple task really to manage international equities for ASB, and through that time we developed a lot of trust. And if you think back, all of the events that have taken place since then, and obviously the COVID period in March 2020 was the really big change. I think equity markets were down something like 35% at the time. And riding through that period, and there was a big V. There was a really big uptick after that. There were rebalancings that needed to take place as well, because all of a sudden markets drop a lot. So you're well underweight equities, and then you're well overweight fixed income at the time, and you've got to really readjust as markets come in. And I think we've got a really large investment team in Sydney. We've just opened an office in Auckland. We've got a large capability in Asia as well. And just being able to play out real time the way markets were moving, being able to execute really quickly, being able to talk to ASB's, the advisor community and also end clients and give really up-to-date information at that time, I think really gave John and the team at ASB conviction that it was a partnership that was worth extending. And then since we formalised the whole portfolio partnership in 2021, the pace of change has not diminished. And you even saw it last week in the way markets move, but the pace of change hasn't diminished. And if you go back since that time, inflation really took off around the world. There was the invasion of Ukraine. There was supply chain disruption.
That's right.
I remember one seminal moment really that's played out in markets the last 18 months was Microsoft purchase of OpenAI. And in fact, I was on a hike in the Queen Charlotte's hike in the top of the South Island and was listening to a podcast, the All In podcast.
Oh, yeah, another one, yep.
Yeah, and they were talking about, Microsoft buying OpenAI, and then, NVIDIA was a stock that people in technology would have heard of, but I hadn't been so familiar with it. And, in hindsight, wow, that would have been a good stock to jump on. But balanced portfolios have played out very nicely, actually, the last period of time with equity markets going reasonably well. But, inflation, the way it took off, was a really big change. And just being able to work very closely with the ASB investment team to think about portfolios in real time, to communicate to the advisors and to steward investment outcomes that were on a relative basis. We're pleased collectively with the outcomes that clients have got. So, look, that's a tour de force, if you will.
Yeah.
But it's been a fantastic experience, I think, for us collectively.
Now let's get on to talking about what we do best, and that's investing our customers' hard-earned savings, which can also sometimes be termed running the money. Our listeners will be aware that BlackRock are responsible for asset allocation and currency decisions. Well, they might not be aware, and this is news, but this is the key things. But another feature which is perhaps less well known is that BlackRock and John's team can use derivatives to adjust the level of risk in our portfolios. For those that are unfamiliar with derivatives, Will, can you please explain what this means for clients, and then when BlackRock might use these tools?
Well, Nigel, straight into it there on questions about derivatives. Perhaps we take a step back and just think about that process. And derivatives are really just one component of what we call risk mitigation. So we have this ability to utilise some tools in a kit bag to manage the risk of our portfolios or ASB's portfolios. And that's important because what BlackRock does is we really have a very risk-based approach to how we manage the portfolios. And therefore, as we get market gyrations and things move in markets, it's important for us to be able to kind of manage that risk and make sure that the end client is getting the experience that's consistent with their risk profile or the risk that they're wanting to take. So what we can do there when we see periods of heightened risk, or we're forecasting periods where we might see some heightened risk, we can manage the amount of risk that we're taking within those portfolios. And derivatives is an efficient form of being able to manage that risk. And the two most common ways that we've been able to use that is one structure called futures contracts, and the other is using options contracts. And perhaps I'll talk about the options because it's a tool that we've used most recently.
And I'm sure as well people would know the term and probably would welcome a little bit of being taken to school a little bit.
Yeah, no problems. And look, there's really a formal process to this. So if we start to foresee something on the horizon that perhaps looks like it could create some volatility in portfolios, we have a very formal process where we sit down with our internal risk teams, our portfolio managers, Australasian CIO. There's a lot of people there that provide their insight for us. And we discuss what we may need to do. And then it's really about how to best express what we want to do in portfolios in terms of perhaps reducing some risk. And as I said, I'll talk to this put option example. So in April of this year, those who are keen market watchers will remember that markets had kind of got a little bit ahead of themselves and were forecasting pretty aggressive rate cuts at the time. There was a very strong narrative that we're in this soft landing environment, that inflation prints were coming down, et cetera, et cetera. And it was our opinion that perhaps markets got a little bit ahead of themselves on that front. And so we structured a transaction in portfolios that would have protected portfolios had the markets fallen. And this is what we called a put option structure. And that gives us the right to sell, but not the obligation, to sell an exposure at a pre-agreed price. And that means that if markets were to fall, we could execute that put and sell those positions and protect the portfolios somewhat. Now, as it turned out, markets carried on a little bit from there, and it was a very efficient expression because had we used something physical and gone and actually sold our global equity exposures perhaps to the same extent, we would have missed the entirety of the rally. Instead, we had an upfront cost that was the cost associated with the put option. I think it was about 2 basis points or something for a balanced portfolio. And if we had expressed this physically, it actually would have cost the portfolios about 25 basis points in relative performance. So as you can see, it's kind of an efficient way for us to make sure that we're putting the protection in the portfolios where we think we might need it, but also not giving away too much if markets continue in the opposite direction to what we're trying to express.
Sure.
So I often think about the risk mitigation trades, or particularly the one-sided nature of the risk mitigation trade that you just talked about there, Will, is a little bit like insurance, right? You pay an insurance premium against a certain event occurring, right? So maybe your house burns down, right? Okay, well, if your house doesn't burn down, then you've just paid a little bit of money, and that's a good outcome. But if your house does burn down, then you get the value of the house back. It's sort of the similar type of concept, and you use the term premium when premium's associated with insurance. So it's a very similar concept, and I think that the key for me is derivatives can often be, for a lay investor, sound quite a scary concept. They're often used to speculate. People are taking bets and stuff like that. Well, actually, that's not the purpose in terms of what they're being used for. Their risk management is the key, and they're just a very efficient way of avoiding the cost of buying and selling assets, which is actually quite an expensive thing to do. So, it's a technique that is well used and well understood in the marketplace, and it just helps to manage the fact that you tend to invest, and you should invest, with a longer term view, but sometimes things happen in the shorter term that you need to try and deal with, and that's essentially what we're doing through these risk mitigations. So yeah,
exactly right.
And it's probably I'm sure a lot of investors aren't aware of kind of that constant monitoring that you are all doing. Yeah, it's certainly not a case of set and forget.
No,
and that's that's the expertise you get when you have smart people like those in front of me or to my right looking after money. Yeah. And since the partnership has started back, or the formal kind of, the extended partnership in 21, we've seen the portfolios evolve. We've seen, new things come in like gold, US linkers and an NZ linkers, which is otherwise known as inflation-linked bonds. Chaps, are there any other new asset classes on the partnership's radar that we might see in ASB portfolios or customers' portfolios in the near future?
Maybe I'll talk a little bit around what we've done in asset allocation more recently, because we have just updated the asset allocation for this year. And really, it's important to think about the backdrop that we've seen over the last 12 months. And there we've seen, a real bifurcation in terms of market performance. So when we look at global equity markets, the US equity market was up about 17% over the 12 months. In New Zealand, it was pretty flat over that same period. And we've also seen the same in bond markets. We've seen, real differences between markets there, where we've had, again, I'll use the US as an example. US was, rates came up about 50 basis points, I think it was, from 3.9 to 4.4. And in New Zealand, again, pretty flat, around 4.7. So, and a real variation, I suppose, in inflation and inflation outlooks. And that's a really important piece, given what markets are really focused on at the moment. And then you tie that sort of historical context within sort of the mega forces that I know we've discussed a little bit on this podcast. And that really lands on where we've made some sort of minor changes to portfolios for the upcoming period. So really, big picture, we're slightly a little bit underweight growth relative to what we would call a neutral position. And really that comes down to kind of narrower expected return outcomes between those growth assets. So think equities and property and infrastructure and things like that. And your fixed income or income side of your portfolio, so bond yields and the like. So the expected return differential between those two sort of major cohorts of asset classes has narrowed a little bit. So on the growth side of portfolios, really kind of very modest changes in terms of what we've done to portfolios at this stage. A small increase to emerging market equities across most profiles. And really that comes down to kind of, again, leaning into these mega forces a little bit. So we've got this mega force I'm sure most of the listeners would be aware of, which is this demographic divergence. And that plays really nicely into emerging market equities, where we've got, very or far more attractive demographic profiles versus what we might see in developed markets. And also it plays into this geopolitical fragmentation. So as we see supply chains rewire, there's bound to be some emerging market economies that are going to benefit from that. So we're trying to kind of lean into some of those risks there. And then on the growth side, and I alluded to some strong equity performance that we've seen from global markets, but we continue to kind of persist with that little bit overweight global equities versus domestic equities or Australasian equities. And again, that really comes down to these kind of mega forces as well. So yes, we've seen some pretty strong performance out of global equities, but perhaps justified when you think about the earnings growth that we're seeing out of the major contributors of kind of global equity markets. And again, leans into some of these mega forces. So
they're everywhere, these mega forces.
That's exactly right. So we're able to capture this kind of technology and artificial intelligence a little bit easier in some of these global markets as well. And then on the income side, income side of portfolios or the defensive side of portfolios, maybe slightly more changes a little bit there, a little bit more of a domestic bias in terms of some of the fixed income components of the portfolio. And this has really come out of sort of some global nominal bond exposure and also some inflation-linked bonds. And I think really it just comes down to the fact that we think sort of domestic assets may be able to protect portfolios a little bit better on a go-forward basis, and some of that opportunity is better expressed in a domestic fashion. And then, of course, we maintain our position to gold. We have trimmed it a little bit versus where it was previously. And again, that's not gold was never in the portfolios because of a stellar performance expectation. It was always there for diversification benefits of the portfolio. And again, kind of leaning back to where what I was talking about in terms of fixed income assets and the increase we've seen in bonds, bond yields, should I say. That really paints a picture of perhaps maybe a little bit more diversification benefit coming from those assets relative to what we expected when gold was introduced. So when we introduced gold, bond yields were sort of very, very low, and the expectation of any diversification benefit out of those traditional fixed income assets was perhaps a little bit more muted. Now, look, we still maintain gold in the portfolio because we do think that maybe that diversification benefit from traditional fixed income may not be as present as it historically has been, but we thought it was probably appropriate to maybe trim that position a little bit. And then if we think about what's coming up and what we're looking at, and I know Nigel's all excited now.
Yeah, like a good radio tease. Here's what's coming up after the break.
That's exactly right. I was going to leave it on a bit of a cliffhanger and say we are working on something, but I'll dive into it a little bit. And really, I've talked about these mega forces a few times and mentioned them. And there's one asset class we think in particular that kind of sits at the cross-section of a lot of these mega forces, and that's infrastructure. So really, if we think about the mega forces, and I'll touch on them each because they are important across the infrastructure exposure. And the first is this geopolitical fragmentation. And again, as we get supply chains rewiring a little bit in the face of this kind of more geopolitically tense environment, there's a lot of infrastructure that's required to facilitate that transition to changes in supply chains. And certainly infrastructure is a beneficiary of that in traditional infrastructure that we think of, so toll roads or trains or ports or whatever it might be. Obviously as supply chains rewire, this is obviously going to be an important piece of the puzzle. And then again, when we think about demographics, we've got changing demographics between developed markets and emerging markets. So in developed markets, you might have different infrastructure needs in the face of kind of an aging population.
Healthcare.
Yeah, that's exactly right.
Yeah.
Versus what you might get in emerging markets where you're sort of trying to facilitate some growth and how you support those growing populations, I suppose. And then if we think about tech and Gen AI, again, infrastructure plays an important piece in this. There's going to be significant power needs as we kind of facilitate this kind of transition into a more AI-dominated world. Again, you just think about the power needs of these places, and then you think about data centers that are required. And data centers is kind of quasi-infrastructure, quasi-property, but it's obviously an important component of kind of facilitating the ongoing adoption of these technology and AI. And then, of course, the obvious one is the low-carbon transition, and obviously that is predominantly infrastructure. Yeah. So when we think about all of the infrastructure development that's required in order to facilitate, the transition to a more low carbon economy. Obviously, that's very infrastructure heavy. So I'll leave it there. There is one final mega force, which is the future of finance. A little bit more difficult to kind of tie a direct link to that. But perhaps you could kind of talk to the kind of fiscal positions of most global economies. And I think Jason's going to touch on that a little bit if you wanted to.
Yeah, I mean, I think there's a couple of things to pick up from that, Will, as well. The first one on demographics. If you look at the demographics of the G7, the most developed economies in the world, you've got an ageing population. And with an ageing population, you've got a reduced tax base. You've got high levels of government debt in that G7. And so the question is, how do you finance such large infrastructure needs with a lower tax base in those countries? So that's a real global challenge. It's one that organisations like ourselves are leaning into because we're trying to facilitate the flow of capital and find new ways and new structures to enable private money, pension fund money, KiwiSaver money, to go into these asset classes. And also in a retiring world, in that G7 world, as an asset class, a long duration asset with some equity upside, which is the characteristics that infrastructure has traditionally played, ought to be appealing. So we think infrastructure is a tremendous asset class to consider in the future for these, you call them mega trends, but they're real kind of four things I think you touched on there, right? It was the digital economy, demographics, supply chains, and transition to net zero. And then, the overlay on all of that is high levels of government debt around the world.
John?
Yeah, so to think about that, infrastructure then is a really, really strong theme, and a theme that we're thinking about very, very carefully with you guys in BlackRock about putting into the portfolio. And then the question is, how do you actually put that into the portfolio? And as Jason was alluding to, there's more and more direct assets, more and more money flowing from funds like pension funds and superannuation funds, KiwiSaver, into direct assets. That's been a thematic over the last few years. And that's something that is quite challenging for us to think about, but something that we're spending quite a lot of time thinking about. So I think that's probably the forward-looking part about what's going on with the strategy at the moment. There's quite a lot of thought that we're putting into both those spaces.
Yeah, it's John. It's really interesting that you lay it out like that. And if you look at the exposure that institutional investors have been able to get to private markets over the last few decades, it's benefited them enormously because there's a private premium really that's been assigned by allowing your money to be locked away for a period of time. The return profile has been higher and I think in general, it's something in the order of 25 to 30% of institutional investments go into private markets. And if you look at the retail investor, it's somewhere between 0 and 5%. So they just haven't had the access. And one of the things we're trying to work out is how do we democratise private markets? How do we make them more accessible? And it's something we've done traditionally in the past. BlackRock has through ETFs. We've democratized investing by lowering the cost of investing, by increasing the ability for people to go in, by simplifying instruments, which ETFs are really a technology that allow you to do that. So that's one of the things we're really working hard on at the moment, is coming up with ideas, coming up with structures that make private assets more accessible. Now, part of the challenge there is education, because they're not accessible for a reason as well, because you've got to put your money away for a period of time. So they're not easy problems to solve for, but they're things that we're working on.
So with all those mega forces going on, and undoubtedly these are things that sort of, we got decades away, sort of influence going ahead with those things. Looking ahead though for the next 12 months, I guess to Jace or Will first and then John, I guess quickly, what do you think are the critical things of the next 12 months that could make markets move?
Yeah, look, 12 months is always an important, I think, piece for people to consider. It's always front page of the newspaper, anything that's happening in the near future. And there are a few events that are no doubt going to kind of maybe create a little bit of volatility in markets. And I think the big one that's coming up that most people are looking to is the US presidential election. Mm-hmm. And we've had plenty of experience with elections over the course of 2024 thus far, and that has no doubt created some volatility. We look at France and the election. There was definitely some volatility that both preceded and followed that election. And then in the UK, we've also had another election where maybe create a little bit more stability. And then we've seen, a number of the emerging markets kind of had some interesting political outcomes. And I think the important piece really here is, yes, there's no doubt some risks on the horizon, but portfolios that we are building are structured to kind of look through these events. And as we talked to earlier, we do have these risk mitigation tools in our back pocket should we think it's warranted. But generally, the portfolios are positioned and we set them up to kind of be rewarding the investor over a strategic horizon. And that's how we think about things.
Designed to endure.
That's exactly right.
Jason?
No, I mean a lot of volatility over the next 12 months, likely dispersion as well.
Yeah.
So there's opportunities with that. There's opportunities to be really active in your process around selecting asset classes and even underlying managers as well. But as Will said, staying invested through the course of time is kind of a key objective of long-term savings.
And that never changes. John?
Yeah, look, man, I agree that it's going to be volatility. I think the thing for me is really just the trade-off between the way people think about growth, inflation, interest rates. We've seen this play out in the last few days, just the changing views on that. And I think that we're going to see a year ahead as we've been in a high interest rate environment and everybody's looking for the turn. It will be the changing views on inflation. How worried about it should we be? And growth, are we worried about it? Oh, should we be worried about it? Should we be worried about inflation at all if we don't have growth? And then interest. It all plays together, and I think that views on those things in most markets are going to shift quite a lot, which will be the thing that will create the volatility. And with that volatility, it comes back to having a longer term view, and savings, particularly retirement savings, are invested for the long term. Don't react. Just look ahead, look through it. Will be the key. I think people get really, really bound up in the election, the US election, but I'm not sure. And history shows that it doesn't actually have much of an effect. So, yeah, it's going to be interesting.
Now, over the past 3 years, ASB's learnt a hell of a lot from BlackRock's experts all over the world, everything from AI to climate to mega forces. And that doesn't even cover off all the plumbing and technical work that the guys do behind the scenes. John, what's your favourite, callback or memory of the past 3 years from working with our partners?
Look, I mean, in general, it's just been an enormous pleasure to work with the team. They're just a great team, and there's a strong cultural alignment. So that's just a broad favourite memory. But the specifics is actually there's a guy from BlackRock called Brad Betts, who's their AI geek. Well, I don't suppose he's I think about him as the AI geek, but has he actually been doing this stuff for years and years and years, well before AI became a thematica over in the last couple of years. And he's just so articulate and so smart. And he just represents to me just like that's one of the people, but there's plenty of other people like that in BlackRock, and just reinforced to me the sort of like capability that we really have leaned into with this partnership. So, yeah, that's key for me.
Mark, before I pass to you, Jason, my quick point was just I think it's been evident over the 3 years, and John's obviously worked you for a lot longer, but when you work with the world's best, it does lift you, and forces you to be on and, and you learn everything, more and more every day from you guys. But I think that's sort of, there's that saying about, lifts all boats. I think it's been there. Jason, from your side?
Nigel, I think you've lifted us, frankly, and you've held us to account. And you said favourite memory. I just have one really clear memory, which was, and it's a personal one, being on leave up the central coast of New South Wales in Australia, and taking a call from John, and he was really quizzing me on something. He really wanted an answer, and partnerships are like that. You're there for each other. And
you took the call on leave.
I took the call. I was standing on a sand dune, and he remonstrated, and I listened, and we solved the problem. But you've got to have emotional equity in partnerships, and you've got to really work hard for each other.
Can I just ask?
Did you didn't know he was standing on,
so it's just
on a sand dune. It's a new, but that's actually the nature of BlackRock. I mean, they are a partner, and through all circumstances. So yeah, it actually surprises me how often these guys turn up, even wherever they are, right, including on leave.
Markets don't stop. No. They don't stop. And any event that happens on the street on any given day can have an impact.
I'm just going to make sure that on calls now, I'm going to if someone's not on camera, I'm going to ask, are you on a sand dune? Should you be taking the score? Should you be having Luke? Thank you for your time today, guys. I mean, it's an absolute pleasure to have you over here, and thanks for flying over. On behalf of ASB, John and I just wanted to say, a huge thank you for the partnership over the last 3 years. We say that outside of the podcast, but here publicly as well. We look forward to many more. My final question to wrap things up, and I'm not doing one today, just because we're sort of running out of time. But have you got a latest thing you're reading, watching, or listening to that you can share with the listeners? Will, you want to go first?
Yeah, look, we're right in the heart of the Olympics, aren't we? So I have been in that a lot, but in the upcoming weeks, or in the weeks preceding the Olympics, I watched a great documentary on Simone Biles, the American gymnast, and her kind of ability to overcome the kind of challenges she faced in the lead up and throughout the Japanese Olympics, and then what we've seen in these Paris Olympics is it was just a great kind of flow of events. So that's probably something recently that's been great.
Jason?
I think my favourite book in the last year was a book by Nick Cave, an Australian musician. It's called Fear, Hope and Carnage.
Well, yeah.
And it's a mixture of philosophy and poetry, and it's quite a bit of a deep book, really, but it's actually pretty good to step aside from what you do day to day and reflect.
Yeah, I can't imagine a book that Nick Cave wrote that's not deep, though. So we have to recommend it. John?
Nothing particularly new. Yeah, I've said this before. I'm fascinated by rockets. Yeah, like Rocket Lab in New Zealand is just amazing. Actually, the 50th launch.
50 launches.
Fastest company to reach 50 launches in history. The development and evolution of the rocket industry is quite phenomenal. So yeah, that just continues to fascinate me.
Well, perhaps if they need a third launch pad site now, you could maybe I can put in a good word for you if you want. That's all for today's episode, folks. Thanks again for joining us today. Jason, well, as always, it's been a pleasure to have you over here, and we'll be just continuing this conversation as soon as we get out of the studio. John, we'll see you around the office shortly after this. I can nag you on a few things. And to our listeners, thank you for taking the time to join us, as always. Make sure you tune in next week for our episode and what will be an extra special pre-OCR announcement edition of the podcast. We'll be talking about the OCR ahead of the next RBNZ interest rate decision on August 14. So until then, happy investing, and it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.